Good afternoon, ladies and gentlemen. Welcome to the Barometer Readings Monthly Conference Call. At this time, all participants are in a listen-only mode. Following the presentation, we will conduct a question-and-answer session, at which time instructions will be provided. For operator assistance during the call, please press star zero. I would now like to turn the meeting over to Nick Hamilton. Please go ahead, Mr. Hamilton.
Hi, everyone. Thanks for joining us for another regular update from the folks here at Barometer. I'm joined with David Burrows. So as usual, what we're going to do is provide some context on the markets, what we're seeing in the way of macro drivers, some of the important themes that we're following, where we're seeing prevailing market leadership. So without further ado, I'll turn it over to Dave.
Great. Thanks, folks, for taking the time today. What I want to do is sort of through our lens give you a picture for what we're seeing going on. As has been the case for some time, there are some pretty clear themes in the market that we're in. Of course, there's always cross currents. And we've been working hard at applying the Barometer process in the various portfolios that we manage. As I think all of you know, we really come at this two ways. We run our top-down breadth models to try to identify pockets of the market that are seeing net inflows of capital, find neighborhoods that have a tailwind, and work at avoiding some of the groups that are seeing net outflows where breadth is deteriorating, and structure our portfolios so that we focus in parts of the market people care about now. And then, of course, within those themes, we use our bottom-up process to try to identify securities where something's changing for the better, where we think we can get revaluation versus the peer group. So ultimately, we're trying to find value three ways. We're trying to get to the right asset classes. We're trying to get to the sectors that have some structural tailwind, and then within those groups find, using the bottom-up process, some individual securities that have a strong likelihood of being revalued based on some positive change. So through that lens, we start from a top-down process with our asset allocation. And in the equity asset class, we continue to see very slow, steady improvement in breadth, really in many different ways. Globally, 52% of stocks are in long-term price advances. This has been at this level now for a few weeks. There have been days that are good and days that have been bad, but breadth has been stable. So that means that some stocks are rallying, some stocks are not participating. Roughly 1 in 2 stocks is performing well. But despite the fact you get little pullbacks here and there, trends are intact. So money is working its way into the equity asset class, and we know geographically some countries are doing better than others. The U.S. has been a standout for a long time, and in the U.S., 60% of stocks are performing well, and that has been very, very stable. Canada, over the last few months, has shown some improvement after having been weak since September of last year. But very specific areas of the Canadian market. Only 40% of stocks in Canada are performing well. 60% would be on our avoid list, and that includes some pretty key sectors of the Canadian market. So while Canada is getting a little better on a relative basis versus the S&P, it's really been underperforming the S&P since July of last year when energy came under pressure. So Canada is interesting to us in certain sectors, but certain sectors are avoids. If you go back to where we were in the last conference call that we made, if you went country by country across the globe, the average country had about 42% of stocks in positive long-term price advances. Since then, it has improved. It's currently sitting at about 46%. And it continues to be the case that the majority of countries where we're seeing expanding breadth are more consumer-focused markets, where resources do not play a large part of the market, where there is benefit from low energy prices and low commodity prices and low inflation. What's interesting is that while the U.S. remains very firm, we're seeing marked improvement in areas like Europe. And within Asia, specifically the Japanese market, which, going back to the early 90s, was a very important market globally, is showing some real improvement, really for the first time in many, many years. So what I would say is that while breadth is expanding in the key markets that we focus on in North America, we're also seeing expansion in Europe and in major markets in Asia. Importantly, beyond that, we know that the market has been fairly focused on large caps over the last few years. We've seen very marked improvements in the mid and small cap indices as well, not in Canada, but in the U.S. in particular. And so it's interesting. From a breadth perspective, things are getting better. We know that the indexes have been trading near highs, S&P and NASDAQ, but more importantly, Russell 2000, which is very domestically focused in the U.S. small cap indices hitting new highs, and on a relative basis actually are outperforming the S&P. And that obviously has something to do with the fact that strong dollar does weigh on earnings for the largest of the S&P companies. But it also, I think, has to do with the fact that the U.S. is probably the biggest beneficiary of low oil prices. From a currency perspective, the U.S. dollar continues to be the dominant theme. And like in anything, there's going to be short-term pullbacks, but there's a very clear theme: U.S. dollar versus euro, U.S. dollar versus yen, U.S. dollar versus emerging market currencies, and U.S. dollar versus commodity-related currencies like the Canadian dollar and the Aussie dollar. As far as economic data goes, Europe has been seeing some improving economic data. In the short run, U.S. economic data has been underperforming. Recently, it looks like it's starting to turn back higher. Today's new home sales were very strong, plus 7% versus expected, a negative result. CPI data coming in a little bit better. But the emerging market data continues to be sloppy in in China, in Russia, in Brazil, through much of Latin America, and we continue to see risks there. So our overall view is that equities continue to be the asset class they're seeing net inflows. Consumer-led developed economies are the target. Where we can hedge currency, we can have some exposure to Europe, and we do. Where we can have Japanese exposure, we can and we do on a hedge basis. And from a thematic standpoint, small and mid cap is becoming a more important neighborhood for us to be focused in. So as most of you know, we have had the view that we are in a secular bull market. I think that was reinforced over the last month with the NASDAQ making the first new high since 2000. That breaks the NASDAQ out into secular bull market territory, early stage, not late stage. And the U.S. dollar, which has historically had a very high correlation to a strong stock market, continues to have a strong upward bullish trend. So we continue to be bullish. When we look at sectors, our job is to manage change. From July of last year, where our income fund was 40% energy, today sits at about 4%. Breadth continues to be very sloppy in the resource sectors, and so these are areas that we're avoiding. On the other hand, the sectors that benefit from low commodity prices and low input costs, are performing very well. What's bad for an oil producer is good for a consumer of gasoline, and gasoline prices are in the same range that they were in all the way through the 80s and the 90s, where the consumer had such a positive backdrop. So low interest rates and low energy prices, we know historically flow through to the consumer. You have to remember that there's a lag, and it doesn't come up all at once. You don't necessarily see it in the economic data immediately, but you will often see things happen in the stock market before you see them from an economic data perspective, and we certainly are seeing that. When we look at the sector work, the consumer sector in the U.S. in particular, and frankly globally, is by far the strongest sector. And whether you're looking at consumer discretionary, sectors like leisure, travel, retail, very, very strong, and we're very focused in those areas. So consumer, big beneficiary. Of course, U.S. market, 72% of the economy is driven by a consumer, so in many different ways there you can invest in that theme. Healthcare, which is again very domestically focused, is a beneficiary. More disposable income, of course, demographics playing into it, and we're also seeing strength in defense, which is domestically focused, technology also. So there are some very clear themes, and these are not changing. Now, early in the year, there was some strength in interest rate proxies based on the economic concerns. REITs and utilities had a bit of a lift in January and February. This did not look to be a sustainable theme for us. We chose not to focus on it. They, since end of February, have underperformed markets. So when we get to the portfolios and as to how we're expressing our view, I guess what I wanted to do today is start off with talking about the purest form of expressing our view. We, as you know, have an ETF pool, which is really a global macro pool, which invests across 5 asset classes: equities, fixed income, real estate, currencies, and commodities. It's a long-short portfolio and really is just focused on using our top-down view to build a portfolio and express it using ETFs to take out business risk. And just to put a point on our overall view, this portfolio today is geographically heavily focused on the U.S., about 80%. About 10% would be Japan, and 10% would be Europe. Both of those are currency hedged. On the long side, the sector exposure is skewed 25% towards the U.S. consumer discretionary sector, 16% to the healthcare sector, and 15% to technology. Those would be our key sector exposures. From a market cap perspective, 36% of the portfolio is focused on mid and small cap securities, again using ETFs to protect against the business risk of the individual underlying securities. And then only about 7% of the portfolio would be focused U.S. large cap. So that's on the long side. It's equity focused and very U.S. centric. This is a long-short portfolio, and I only use it to express sort of our macro view of the world. On the short side, we are short energy producers and service companies, both by way of ETF, gold itself and gold producers, emerging markets, specifically Latin American countries where currencies are weak, and euro and yen. So that gives you a sense for how we're expressing our view from a structural standpoint. When we take the top-down view and apply it in the underlying mandates that we run, of course, the important one to a lot of people is the income portfolio. The income portfolio is structured for what's coming next. So as you know, our tendency is to build a portfolio that's focused in some clear themes, stay there as long as they work. We went through a fairly large structural change in 2012 as we moved away from interest rate proxies towards dividend payers and energy. Into 2014, we rotated away from energy to dividend growth securities, and as we sit today, we're focused in sectors that look to be benefiting from, and we would expect to benefit from, low energy prices and low inflation. So the high income portfolio today is about 95% equities to benefit from the flow from other asset classes into equities. It's focused in companies with low dividend payouts but high dividend growth. And we think that based on our view of an improving underlying economy in the U.S., we are going to see accelerated dividend growth. Specifically, we're focused in sectors that are domestically focused, and they include financials, which is about 26% of the portfolio, almost entirely U.S.-focused financials, regional banks, financial technology companies, and asset managers benefit from stronger markets. Consumer discretionary would be the next biggest weighting in the portfolio at 17%, and that includes retailers, leisure companies and travel, and airlines. Industrials, which largely is automotive companies and transport. Healthcare is about 9% of the portfolio, made up of biotech, pharmaceutical, and HMOs. And then technology would make up about 6% of the portfolio. It now is over 60% skewed to the U.S. We recognize that the clients in the income portfolio are looking for a lower beta experience, and based on the large move in the Canadian dollar, we have hedged 50% of the currency exposure, frankly, just to make sure we're not sitting with any large exposures that could subject us to a reversal. Fixed income is virtually negligible in this portfolio, given where we're at ultimately 500-year lows in interest rates. We don't see upside in focusing in fixed income in this portfolio, and frankly, part of the value of this portfolio is not being constrained and having to focus in something that we think offers no opportunity. Corporate debt is 1.9% of the portfolio. We go through these transitions from time to time. The income portfolio is positioned for what we think plays out over the course of this year in sectors that have very clear themes. And while we'd like to see a stronger start to the year, our view was that to focus in utilities and REITs that were purely really an interest rate play was much like owning a bond portfolio, probably didn't have much future in it. So there we sit today, and we think that this sets us up well for the rest of the year. In the equity portfolio is less focused, of course, on yield, a little bit more focused on growth. It's nice that it's a relatively small portfolio. We can be fairly concentrated in some of those names that do have some of what would be scarce growth in the market. Technology makes up 24% of the equity portfolio today. Of the total portfolio, 54% is in the U.S. Of course, a lot of the technology investments we have are U.S.-based securities. And the technology holdings are largely semiconductor-focused, like Avago Technologies, NVIDIA, NXP Semiconductors for near-field communication chips, Palo Alto Networks, which is security software, and Skyworks, which is components going into mobile devices, and I guess also Broadcom. When it comes to next biggest group is healthcare at 19% of the portfolio, combination of pharmaceutical and biotech exposure, Actavis, Biogen, IDIC, and Zoetis. We also have Concordia Healthcare, CVS on the drug retailers, and Valiant Pharmaceuticals. And then, so IT, 24%, healthcare, 19%, consumer discretionary, 18%, consumer staples, 14%. So again, very focused in sectors where we're seeing good net inflows. This portfolio is unhedged from a currency perspective. Our equity portfolio more focused on capital growth. We can take a little bit more volatility in the portfolio, and ultimately our fundamental view is that the Canadian dollar likely continues to back off ultimately versus U.S. dollar. Last one I'll focus on today is the balanced fund. We're seeing some good net inflows into this portfolio, so certainly we appreciate that. Apparently there is appetite for clients who do need some fixed income exposure. I've been really happy with the way that Jim Brennan and Paul Campbell have been able to build an interesting list of rifle shot opportunities in corporate debt. They're very good at looking across the capital stack and identifying some very special situations. So corporate debt in the balanced fund today is 23% of the portfolio, and they are finding some interesting ideas. Beyond that, we are largely focused in the sectors we've talked about, financials at 26%, consumer discretionary at 12%, consumer staples at 8.4%, and healthcare at 5.8% of the portfolio. So I guess I just want to recap a couple of things. Indices are trading within days of their highs. Small and mid-cap stocks are outperforming. Semiconductors, a great indicator of expectation for economic growth and market health, are trading virtually at the highs. We have breadth expanding around the world. We have good, strong dividend growth coming through in the portfolios. We are seeing inflows from around the world into North American assets. So we see tailwinds in this market. I think as we go forward, there's going to be lots of things that people worry about. One of the keys in a bull market is that it's always easier to feel good about selling because everybody wants to be smart and pick a high. The hardest thing to do in a bull market is to stay with the things that are working. And we see some very clear themes in this market. On the other side, it is remarkable to me the amount of money that's been raised to refinance energy companies. People have a tendency to look backward at what has worked for them recently, and it's easy to buy something when it looks like it's on sale. I think that when we look at the inventory levels and when we look at the production growth, there's very little sign that this sell-off in energy is over. Now, not to say that they can't put in short-term bottoms and have a rally, but I think that they could be relatively short-lived, and we would be cautious about focusing and trying to pick bottoms in these things. So we're looking forwards. It was hard to step away from some of the energy infrastructure companies. It is a great business model, but the reality is that if energy prices were to remain weak for a while, they do ultimately become pretty vulnerable. So we're heading here into the second quarter of the year. We're bullish. We're happy to take any questions that you have. Don't hesitate to give us a call or operator at the end of this call. We're happy to take some questions. But thanks very much for your trust and the money that you put in our hands.
So just before we get to questions, just a few things. I probably just want to highlight some year-to-date performance because we've been having conversations. I think one of the things we're quite delighted to see is the diverse of behavior and performance among our different strategies. So on a year-to-date basis, if you look at the tactical ETF pool that was highlighted, it's up nearly 12% on the year. Our equity fund and pool up 10% or more. Long-short equity pool 9.5% year-to-date. Clearly, we have spent some time highlighting some of the challenges for the income space, and we certainly hope to make progress in that space as well. And that mandate's roughly flat on the year. The tactical balance and the balance fund up over 5% year-to-date. So we have a lot of things that we think that are working. We feel very strongly about our conviction and our positioning. So with that, at this point, we'll open